Afternoon, everyone. I am Indrajit Kaur Bamra, moderator of this webinar. We are delighted to welcome you all in the webinar being organized by Committee on Commercial Laws, Economic Advisory and NPO Cooperative of ICAI. It is my pleasure to be a moderator in Know Your Law Series 48 webinar on navigating the PMLA landscape, responsibilities and challenges for CAs on 2nd February 2024, being organized by Committee on Commercial Laws, Economic Advisory and NPO Cooperative of ICAI. In a short while, we will start the webinar. I would like to apprise you about the committee. This committee is focused to encourage chartered accountants to shape strategy and policy that unlocks economic, financial, and social value while combining analytical foresight with commercial acumen. One of the core areas of this committee is to serve the multifunctional task of analysis, knowledge dissemination, inputs to regulators on policy formulation, to develop and publish technical guidance, background materials, etc., and to create awareness for professional opportunities for chartered accountants in commercial laws, economic advisory, and NPO cooperatives. So, our eminent speaker will talk on navigating the PMLA landscape, responsibilities, and challenges for chartered accountants in this webinar. And we hope that the same shall be useful to all the members. So, ladies and gentlemen, it's my pleasure to introduce Mr. Kinjal Shah, a distinguished professional in the financial and capital markets with over 22 years of expertise. As a fellow member of the Institute of Chartered Accountants of India and a seasoned practitioner since 2001, Mr. Shah holds numerous accolades, including a diploma in Information System Audit (DISA) and certification as an anti-money laundering specialist. He is renowned for his contributions. He has co-authored publications, led investigations for esteemed organizations like SEBI and Mumbai Police, and regularly conducts corporate trainings on regulatory risk management and PMLA. Currently, he is serving as the treasurer of the Bombay Chartered Accountant Society and holding various committee roles. Mr. Shah continues to be the prominent speaker at seminars and meetings, sharing insights on diverse topics ranging from information system audit to financial planning and investment strategies. So let's welcome CA Kinjal M. Shah to our webinar as we eagerly anticipate his invaluable expertise. So welcome, sir.
Thank you, Inderjit. Uh, am I audible clearly?
Yes, sir, you're audible.
Okay. Thank you. So, while the Prevention of Money Laundering Act has been in place since 2005, the act was passed in 2002, but I think it has now started hammering the minds of the chartered accountants more so, especially after the circular which was issued on 3rd of May, where the chartered accountants have been made the reporting entity under the Prevention of Money Laundering Act. And Institute, as a right measure or an appropriate measure, has organized this seminar to educate the members on their responsibility under the Prevention of Money Laundering Act, especially once they become the reporting entity. So, friends, a very good afternoon, and we shall today deal with a very unique subject matter, which is the Prevention of Money Laundering Act. How do we, as chartered accountant, navigate this landscape, understand our responsibilities and the challenges that we faced, especially when the government, the current in government, is very meticulous, very on has taken up that responsibility that unless the financial transactions are monitored, it could always lead to terrorist acts, and therefore the not only the chartered accountants but the company secretaries, cost accountants, and various other intermediaries, institutions are part of the reporting entities. I'm thankful to the Committee on the Commercial Law, Economic Advisory, and NPO of the ICI for giving me this opportunity to share my views on this subject matter today. So, friends, today's agenda would be to have a basic introduction to the concept of money laundering. We'll understand what are the important provisions of the PMLA Act, the basic background of the FATF, which is the Financial Action Task Force, the need of PMLA for professionals, why is this circular or the gazette notification being issued, which is 3rd May 2023. We will also discuss the said notification and its applicabilities, understand what are the acts of chartered accountants which are covered under this notification. Having understood that, we need to understand what are our obligations as chartered accountants, since we would be the reporting entities, the registration processes, what is the registration process, the policy and procedure, what are client onboarding process, what is transaction monitoring, what is reporting, and other obligations. While FIU, IND, or the government has also cast its very important role on the ICAI being the nodal agency to coordinate between the government and the chartered accountants, which are the practicing members holding COP. And we will touch upon the Gazette notification dated 9th of May 2023, because that also covered some of the important aspects which were not covered by the 3rd May notification. So this is what we are trying to do. While I will be covering all those the important aspects, we will take up question answers as per the guidance of the moderator. If the moderator feels any question which is very relevant to what we are discussing, the moderator will take up those questions. If not, we will take up the questions at the end of the session. So in Inderjit, you may feel free to ask me any question. I mean, because members would be posting it on the chat box. And if you feel there are any relevant questions which needs to be addressed, you can stop me or we'll take up. I mean, if they are not very important, then we may opt to take it at the end. I leave it to your discretion.
Okay, sir.
So, introduction to money laundering. What are the basics of the money laundering and the PMLA Act 2002? Now, as such, we all know what is money laundering. Money laundering is something where we try and disassociate the origin of the proceeds. I'm not saying here the proceeds of crime, but I would say money which is illicit, illegitimate, or which is generally called as dirty money. We process it so that it appears to be legal or clean. So accordingly, the United States Treasury Department says that money laundering is the process of making illegally gained proceeds or the dirty money appear legal. So this process is something which is called money laundering. In India, it is also called hawala, but we all understand what is money laundering and what is hawala, being closely associated with the field of finance. So money laundering is a consequence. Why does it happen? It happens because almost all profit generating crime, they can occur anywhere in the world. And the objective of the money laundering is to get the illegal funds back to the individuals who generated them, or what we called as launderers, who usually prefer to move these funds through stable financial systems. And therefore, financial systems, they they work as a, a, a backbone of this money launderers, thereby helping them to launder the money. And that is where every aspect or the instrument of this financial system should be synchronized so as to generate timely alerts and information coming to the law enforcement agencies for them to track it on a timely basis. So, having understood what is money laundering, let us understand how is it done. So, here we are not discussing the modus operandi, but we are broadly discussing what are the stages involved in money laundering. So, this could be broadly divided into three stages. The first being the placement, where the dirty money is inserted in the financial system. The second is the layering, where you separate the proceeds from their criminal origin by moving them through a series of financial transactions. And third, integrating or creating a legitimate explanation for their source of funds, allowing them to be retained, invested, or used to acquire goods or asset. While this process may not every time occur in the same order as it has been described here under above, but more or less these are three important aspects of money laundering, and therefore we need to understand this as placement, layering, and integration. So this is a diagrammatic representation of a typical process of money laundering. And to give you a more simpler example, say for example, somebody has acquired illegitimate money, like say for example, a bureaucrat or a government official or somebody in the higher government office, due to say corruption, he has acquired the money. Now this dirty money is illicit, illegitimate. He can't keep it with himself. He can't spend it on the luxuries or to acquire assets for himself or his family. And therefore, what he will try to do is he will try to launder it using various channels available in the system to convert this dirty money to appear as legitimate or clean money. Like say for example, somebody has acquired say X amount of money, let's say 10 crores hypothetically, as a part of a consideration for some favors given to uh, some institutions or corporate for the granting an order of a government contract. He has received this money. Now, what he will do? He can't keep it with himself. So he will distribute this money into various smaller processes to integrate it or place it into the financial system. Now, let's understand this with an example. Say, for example, he acquires a cafe or a restaurant, a small restaurant, uh, as a part of his, in the name of somebody in his family. Doesn't require much, I would say, investment. And he starts this cafe or restaurant. And say for example, that restaurant had a very good business, a legitimate business, which was earning or having a daily revenue of say 10,000. Now, once this is acquired by somebody who doesn't intend to run it as a restaurant, he would allow the restaurant to be run on its own. But whenever on a daily basis the cash collection, because the restaurant generally receives the funds in cash, and what it will do is on a daily basis it will go and deposit this cash into the bank. Now once this money is deposited into the bank as a legitimate business transaction and it is integrated into the system, it becomes difficult, because say for example that hotel or restaurant was acquired in his son's name, and then with the annual turnover prior to its acquisition which was 2 crores, it will gradually increase from 4 crores 6 crores to 10 crores, and all that illegitimate illicit money would be put officially into the banking channel, and this money, after paying its legitimate taxes, can be easily utilized for acquisition of assets, uh, or spending it on luxury. Similarly, there are various examples on a cross-border basis where there are over-invoicing or under-invoicing. Companies are acquired in tax havens so that the money that is put into that company, they would be able to hide the identity of the owners, the kind of transaction that it does. And similarly, this would help them to generate clean money into that company and then bring it back to the origin country or keep it offshore as the owner may desire. So now the political declaration and the global program of action was adopted by the United Nations in its General Assembly, which was 17th session in February 1990. And on 8th and 10th June, there was a special session which was held in the United Nations General Assembly on 1998, calling upon the member state to adopt national money laundering legislation and program. Thereby, it requested every member state to adopt corresponding prevention of money laundering laws in their home country to ensure that the money laundering is stopped or is timely detected. While it took such a large time gap between 1990 and 1998, uh, the law would probably have not seen the day of the light had the event called 9/11 not occurred. We all know what happened on 9/11, which is 11th September 2001, when the two heavily loaded domestic flights crashed onto the World Trade Center, and the entire economy of US came to standstill. People were shocked that such a country as powerful as US can also be broken through an act of terrorism. While US was put on red alert, it started searching for all the clues, went after the terrorists. But what it learned as an effect or an aftermath of this event was that this terrorist would have not been able to successfully carry out this attack on an act of terrorism had they not got the finance so easily. US being a very free economy, the movement of funds is very easy. At that point of time, the KYC norms were not so stringent, and therefore the money could flow from the terrorist heavens to US based on which such attack was carried out. Having realized the importance of money laundering in curbing terrorism, it convinced all the member countries to pass a law as earlier as possible. The Indian Parliament passed the Act or enacted the Prevention of Money Laundering Act in 2002. However, since the Act was enacted, but the effective rules or the infrastructure was not in place, it took almost 3 years for the government to come up with all this. And ultimately, on 1st of July 2005, the Indian jurisdiction had its own law on prevention of money laundering, which is called the PMLA Act 2002. If you look at this act, once it was passed in 2002, implemented or enacted in 2005, there has been various amendments which has been enacted to make this law more effective. But if you look at this amendments, typically you will find a pattern that in the first 10 years of its existence, that is from 2005 to 2013, there were only 2 years when this act had some amendments. But if you look at post 2014, when the Modi government took charge in Delhi, we see that almost every year or alternate year, this act has been amended in 2015, 2017, 2018, 19, 22, and 23. So this is the pace at which the government is modifying this act to ensure that this is more effective, it remains effective in curbing terrorist financing, money laundering, and other such illicit activities. This act is applicable to the whole of India, including the state of Jammu and Kashmir. I would say the erstwhile state of Jammu and Kashmir because Jammu and Kashmir is a union territory. But this gives us an understanding of the importance of this law because previously Jammu and Kashmir had its own constitution. They had the right to frame their own laws, including if you look at various civil laws like the Income Tax Act, the Evidence Act, the GST Act, all such act they had their enactment within the state they did not adopt it, or the central act would rather not apply to them. So there are only very few laws which applied to the state of Jammu and Kashmir when the security and integrity of the country or the nation was at stake. Only such laws would apply, and therefore this gives us an importance or understanding of the importance of this act. The preamble to this act is an act to prevent money laundering and to provide for confiscation of property derived from or involved in money laundering and for matters connected therewith or incidental thereto. Uh, there are two acronyms which are used in the industry. One which is the PMLA and the other one is AML. AML stands for Anti-Money Laundering. PMLA stands for the Prevention of Money Laundering Act. Both of them means the same, but they are used interchangeably the regular parlance. So this is just to give you an understanding so that you don't confuse yourself when during this presentation or thereafter somebody says AML or PML, it means one and the same. Let us understand some of the very important definitions of this law. Uh, so the first is the offense of money laundering, which is defined under Section 3 of the Act. So it says that whosoever directly or indirectly attempts to indulge or knowingly assist or knowingly is a party or is actually involved in any process or activity connected with the proceeds of crime, including its concealment, possession, acquisition, or use, and projecting or claiming it as untainted property, shall be guilty of the offense of money laundering. So, what are the important components of the money laundering? The first is somebody has to attempt, try to demonstrate that the illicit money is legitimate money, and he can be either directly or knowingly a party to this process. But the question is, what is proceeds of crime? Let us here also understand the difference between this act and any other criminal act. To give you an analogy, what is more important for chartered accountant is bullet number 2, where it says indulge or knowingly assist or knowingly is a party or is actually involved in. Now, what happens is whenever there is a financial transaction, a layman is generally not highly equipped to carry out such transaction on his own. Uh, at some point of time, he takes advice from consultants who may knowingly or I would say unknowingly give him some advice or he would have provided some assistance to him. And if that is done, a chartered accountant can be prosecuted under this act, considering that he has assisted the accused to convert or launder the money on illegitimately as proceeds of crime to appear as untainted property. So it is very important, and we have come across recently in last 5 to 7 years various cases where the accused, when they are called for interrogation, they would simply say, or just to avoid answering the questions of the law enforcement agencies, they would simply say that I am not aware of this transaction. You may please ask my CA. He is the one who would have guided me on this. And that is where the law enforcement agencies thereafter come running after the professionals whom they deem would have assisted the accused in this process. So, very important learning for the professionals here, that what would be your ethical boundaries and what is something which is unethical, which you should not be indulging into. Now, another important aspect of this is that this entire process applies only if they are proceeds of crime. So it is very important for us to understand what is proceeds of crime. Uh, this act further clarifies that the process or activity connected with the proceeds of crime is a continuing activity and continues till such time a person is directly or indirectly enjoying the proceeds of crime by its concealment or possession or acquisition or use or projecting or claiming it as untainted property. Now, what is this amendment about? Let's say somebody who was part of an illegal crime syndicate, he did some transactions which were illegitimate in a during the period which was prior to 2005. Now, this act practically was enacted in 2002, effectively made applicable from 2005. So, say if this activity was conducted in 1985, there were some proceeds of crime using techniques of laundering. The money was laundered and it was converted to clean money or appearing to be clean money. And out of that clean money, the offender buys a property like, say, gold or real estate. Now, when the law enforcement agencies or the ED, Enforcement Directorate, went to prosecute these people, they said that I do not have proceeds of crime because whatever you call it as proceeds of crime no more exists. I have bought this asset out of this money. And while he also challenges that the crime was conducted prior to the enactment of the law, which is 2002, and therefore he cannot be retrospectively prosecuted under this law. Because if you try and prosecute somebody who committed a crime in 85, while the act was enacted in 2002, it becomes retrospective application, which the courts would turn it down. So what the government did was that even if you continue to enjoy the proceeds of crime, either directly or indirectly, still it amounts to proceeds of crime. So any asset which is created out of those crime money would also be treated as proceeds of crime. Now, what is proceeds of crime? Proceeds of crimes means any property derived or obtained directly or indirectly by any person as a result of criminal activity to a scheduled offense. So it has to be a property which is derived by a person as a result of criminal activity relating to scheduled offense. So what is important is it has to be a criminal activity relating to a scheduled offense. Now, in case such property which was or the money that was illegitimately earned and converted through laundering process into a legitimate means and is then converted or given to somebody acquire another asset. So the law was amended to say that value of any such property. So if I earned some money which was illegitimate, using the process of laundering, I converted that money into some other asset, a form of asset, or I would have disposed of that asset and that asset is no longer in existence thereafter, then it says that value of any such property. So it means that any such property which is owned or is in possession of the accused, the equivalent value of such property, the extent of the proceeds of crime would be liable to be considered as proceeds of crime. Then it further says where such property is taken or held outside the country, then property equivalent in value held within the country. So we had numerous instances where post 2014, when the accused found that it is very difficult to evade the law enforcement agencies, they are very strict. They would enforce the PMLA Act on them. What they did was they ran away out of the country to shelter in some other country. But while going, they also took the asset which were created out of that laundering proceeds along with them outside the country. Now, the law enforcement agencies were finding it difficult to attach the properties because the property no longer existed within the country. So, this amendment tries to say that if an accused of a money laundering act, he has gone out of the country, taken away the property along with him, then in such case, the equivalent value of any other asset which is held within India would also be treated as proceeds of crime. So it says that you need not have a one-to-one nexus. As far as there are proceeds of crime that has been proved, irrespective of whether it is in the same form, irrespective of whether it lies within the country or not, the government authority would have the right to attach that property or confiscate that property and prosecute the person under the PMLA Act. In 2019, there was another amendment, and it was clarified that proceeds of crime include property not only derived or obtained from scheduled offense, but also any property which may directly or indirectly be derived or obtained as a result of any criminal activity relatable to the scheduled offense. So it is not necessary that you have only done scheduled offense, but you have done any criminal activity which is relatable to the scheduled offense. Now, these are all the developments or amendments which came in because there were various court cases which were going on. Based on the judgments of the court, the government thought it appropriate to modify the the law so as to ensure higher success in prosecution. And I would say rather attachment or confiscation of properties. Uh, Now, since we have studied or understood that there has to be criminal activity which is related to scheduled offense, let us understand what is a scheduled offense. There are three categories of scheduled offense. Uh, the part A consisting of 29 scheduled offenses, and there are no monetary limits. So if you commit any crime under this scheduled offense, you are liable for prosecution under PMLA Act. Then you have part B for schedule offense where the monetary threshold is 100 lakhs for initiating the investigation. And part C deals with trans-border crimes where the crime has occurred in another jurisdiction, the accused stays in other jurisdiction. And it consists of two offenses in addition to all the offenses listed under the part A. So let us understand what are the various laws which have been prescribed in part A which would make this law uh, rather make the act a scheduled offense. And it consists of, and this is again only an illustrative list. I have not covered all the 29 acts, but it covers something like the Indian Penal Code, the UAP Act, the Prevention of Corruption Act, Custom Act, SEBI Act, Copyright Act, the Trademarks Act, Information Technology Act, Offense under Child Labor, the Passport Act, Environment Protection, the Child Labor Act, again the Water Prevention and Control of Pollution Act, Air Pollution Act, and of late the Companies Act 2013. Again, I would say that it doesn't mean that this entire law, or say if any of the provisions of the law has been violated, or say it becomes a scheduled offense, because they have specified the sections of scheduled offenses and under the PML Act of that particular law, which when violated would only become the offense of money laundering. Like, say, for example, the Companies Act. It has incorporated only Section 447 of the Companies Act to be eligible or as a part of the scheduled offense, which would make it eligible for prosecution by the Enforcement Directorate. So, what does Section 447 denotes? It is for a fraud. So, all frauds under the Companies Act are dealt with under Section 447, and it also includes all the KMPs who could be prosecuted if the company is found violating any of the specified provisions of this act, like say for example section 447 of the Companies Act. Part C we have already covered. Now part 4, section 4 deals with punishment of money laundering. So punishment for money laundering would be between 3 years to 7 years. But if it is for, I would say, narcotic drugs and psychotropic substance, the penalty would increase from 7 years and it could go up to 10 years. The regulatory agencies, again, this act is very unique in the sense that you always have one regulator for one enactment or one act. Like for CBDT, like for Income Tax Act, we have CBDT. Like for GST Act, we have CBIC. For RERA, we have RERA Authority. For securities law, we have SEBI. But it is quite different under this law, where we have two agencies to monitor or prosecute, or I would say punish the offender under this act. The first is the ED, which is the Enforcement Directorate, and we all know that it's a know it as a draconian authority with vast powers, including for arrest. And we have seen numerous high-profile cases in last 5 to 7 years where people have been arrested by this agency for violations of the PMLA Act. Then we go on to FIUIND, which is the Financial Intelligence Unit. Now, Financial Intelligence Unit uh, is something like a intelligence wing, which we have in income tax or CBD, I mean, in CBDT or in CBIC. So, what does it do is it keeps on gathering the information. While the intelligence wing of a particular regulator or a law enforcer would only share those intelligence with the respective department within that agency. But here the role of FIU has been very different. It is supposed to collect information from various agencies and in turn disseminate it to various agencies. So basically, it facilitates information sharing among various law enforcement agencies and international FIUs. So, what are the functions of FIU? So, broadly, it is collection of information, analysis of information, sharing of information with law enforcement agencies and regulators, and act as central repository for research analysis. Now, what we are going to do is we are going to deal more with the FIUIND because it is an intelligence wing and as a reporting entity, what is our role is more of an interaction with FIU India, while ED will only prosecute those who have been accused under the PMLA Act or have been found violating the PMLA law. As chartered accountants, our role will be to help these agencies in intelligence gathering and provide them with sufficient information. So let us understand what is reporting entity. Reporting entity means a banking company, a financial institutions, an intermediary, or a bank or a person carrying on designated business or profession. Now it has been marked or highlighted. The reason is that chartered accountants have been notified under the last clause, which is person carrying on designated business or profession, and therefore by virtue of this notification, every chartered accountant becomes a reporting entity. Now, let us understand the background of FATF, which is the Financial Action Task Force, which is a global body. Now, what is its role? It's a watchdog for dirty money and terror financing, and it sets the standards for countries to find financial crimes. It evaluates countries and offer improvements or suggestions. Uh, Classifies jurisdiction based on risk level. And I would say India joined the FATF in 2010, and there was an evaluation which was due in December 23 to make sure that the financial system is clean. Now, let me state that one of the major reasons we had this background, I mean, why we had this notification was because of the review that was due for our country, which is India, in 2023. So, why was there a need for PMLA for professional? So, the overall reason was to strengthen and enhance the reporting mechanism, to identify potential offenders. The second is to assimilate, adopt, confirm, and effectively implement the FATF recommendations, which is 24 and 25. Now, what does 24 says? It says that it focuses on identifying and mitigating terrorist financing risk associated with designated non-financial business and profession. While 25 says it emphasizes on customer due diligence, which is called the CDD, uh, measures for designated uh, measures for designated non-financial business and professionals to prevent accounts being misused for money laundering. So as a part of the 24 and 25, we had that 3rd May notification, which includes accountants and legal professionals. Sorry, the 9th May notification includes even the legal professionals under the AML law, and is a global trend driven by recognition of their potential vulnerabilities to be misused by the criminals. While it may appear that India is being overburdened uh, with all these notifications, there is a lot of extra burden on the chartered accountants to comply with. But friends, there are various Western countries like US, Canada, UK, Australia who have already implemented such measures to ensure that their country is able to detect on a timely basis the money laundering activities. Any queries till now? Inderjit, have you got any questions till now?
No, sir.
Okay, fine.
You please continue.
Yeah.
As I will receive the questions, I will speak.
So let us understand the applicability of PMLA to chartered accountants, while the notification dated 3rd of May 2020. So let us understand the notifications. It says that following financial transactions carried out by a chartered accountant, I am not including the words which are there in the notification, which also consist of the company secretaries, the cost accountant as well. Uh, in practice, on behalf of his client, in the course of his or her profession, shall fall under the purview of PMLA 2002. So, what are the kind of activities that if a practicing chartered accountant does, he would qualify to be a reporting entity under this notification? Again, it has to be done not only zone account but through uh, uh, for his client as a part of his or her profession. So, buying and selling of immovable property, managing of client money, securities, and other assets, management of bank savings or securities account, organization of contributions for the creation, operation, or management of companies, and creation, operation, or management of companies limited to for the limited liability, partnerships or trust, and buying or selling of business entities. So, if any chartered accountant, if it does any of the activities stated in 1 to 5 on behalf of his client, that is where the PMLA Act is affected. And therefore, it is very important that before you undertake any activity, you identify whether you fall under this notification or not. So, the notification is applicable to chartered accountants with certificate of practice, either individually or through a firm. So, what are the three important components? The first being actually carrying on a financial transaction. So, you should be actually carrying out a financial transaction. It should be on behalf of his or her client, and it should be in relation to the specified activity. So the specified activities means activities specified at 1 to 5 in this notification. So all these 1 to 5 will form part of this 3rd May notification. So to summarize, it says that funds which are resulting from the specified activities related to financial transactions or required for execution of those transactions are routed through or managed by chartered accountant. So if they are routed through or they are either managed by the chartered accountant, that is where it becomes funds from this specified activities and not otherwise. So once it is done, the chartered accountant becomes a reporting entity, And let us understand what are important aspects or provisions where the chartered accountants, once they become the reporting entity, what are their obligations going forward. So question may arise when it says on behalf of the clients, where the client makes, the chartered accountants makes payment on behalf of his client. So a question may arise in one's mind is that as a chartered accountant, I often make tax payments on behalf of clients. So what my client does is it transfers the money to my account first, and then from my bank account, I make the tax payments. So whether such transactions would get covered, and if yes, whether the chartered accountants would in such case become the reporting entities. So the answer is no. Not all client-related payments handled by CAs fall under the PMLA. The following payments made by chartered accountants on behalf of their clients have been specifically exempted. So I request you all to refer to the notification, the guidance note which has been issued by the FIU IND to the Institute of Chartered Accountants of India, and the subsequent FAQ, which is the frequently asked questions issued by the CA Institute for the guidance of the members. So following would not be treated as transactions carried out on behalf of his client, which is taxes, statutory fees and levies, and registration charges and fees for other professionals such as senior counsel. So, say for example, as a practicing chartered accountant, there is a matter of the client which has gone to the tribunal, and as a part of my service to my client, I am paying the fees to a counsel who is appearing in the tribunal, and I correspondingly recover that money to my bank account. Whether this would have any impact, the reply says no. The PMLA will not apply. You will not be treated as a reporting entity if these are the transactions that are being done by you. The question is, are the following services provided by chartered accountant covered under PMLA? The accounts and book writing, auditing attestation function, special purpose audit reports or due diligence reports, furnishing of returns for other uh, or information related to special purpose audit reports, due diligence reports, or furnishing of returns or information related to direct tax and indirect tax, tax audit reports, services under FEMA, MCA, RERA. Uh, Again, it is repetition, paying of taxes on behalf of client. Uh, if you are making payment for application of PAN, TAN, GST, etc. Incorporation of company and trust, but again not for buying and selling purpose. So there's a difference where they have specifically created two categories. One is you incorporate the company and then you use it for buying or selling it. The second is you incorporate the company, that is you provide your service to the client, you incorporate a company. So let us understand the answers to this. And project financing. So accounts and book writing. No, if it does not involve managing client funds or bank account, it is not covered. Auditing, attestation and certificate service, again, it says not covered. Special purpose audit report due diligence, no, it is not covered. Furnishing of return on or information in relation to direct tax and indirect tax, not covered. Then tax audit and other review services, not covered. Review under FEMA, MC, and RERA, again, if it is not covered as far as managing of client funds or bank account is not concerned. So, if you have taken a power of attorney to do a transaction in the client's bank account, yes, it is covered because then you are not transferring the money to your account, but you are using it directly on the customer's account. Similarly, paying of taxes, application of PAN 10. There are other, sorry, and application of PAN 10, GST, EF, ESIC, again not covered. Then incorporating of companies, LLPs and trust, not buying and selling, again not covered. Incorporation of companies, LLPs or trust, it says that it is covered provided into buying or selling of properties. Project finance, sorry, incorporating of companies, LLPs and trust, yes, covered if it involves buying and selling of such entities. And project finance is something which is very suspicious, very surprising here rather. And it says that yes, since it involves organization of contributions for creation, operations, or management of funds of the companies, it is covered. So project finance is something which every chartered accountant would have to take care before it undertakes such activity. Because if that is the case, the chartered accountants would become the reporting entity. It says whether CA who is acting in the following capacities are covered under the notification. So if a chartered accountant is acting, say, for example, 1 minute. So it says that if a chartered accountant is acting in any of the following capacities, whether it would be covered by the third P notification, which includes, like, say, official liquidator, insolvency professional, independent directors, because here we might be dealing with client monies, or maybe at times channelizing the client money through the bank account directly of the client. The nominee director, the recovery consultant, the executor or will of the will, the insurance brokers, the trustees. So the answer for official liquidator is no, you are not governed by this notification and you are, I would say, not a reporting entity. Insolvency professional or IP, no, not covered. Independent director, not covered. Nominee director, not covered. Recovery consultant, it says yes, if you are a recovery consultant, it's covered. If you are an executor of the will, now a lot of chartered accountants, they become the executor of the will because they're at times the creator of the will feels that if a knowledgeable person like a chartered accountant, who is also more of a family member, if he is made the executor of the will, it would be easier for the other family members to, I would say, for distribution of the assets of the deceased person. So what is important here is that you need to understand that this will be applicable only if there is a client relationship is established. So that means, can I say that if I become an executor of the will of my uncle or of my relative, close relative, it will not be covered under this PMLA. It says, yes, if you are a relative, then there is no client relationship being established, and therefore you will not become a reporting entity. But friends, what is important here is that even if it is not applicable, it is because that you are stating a fact or considering the fact that there is no client relationship. But in numerous cases, we see that your uncle or your relative is also a client for some other services. Like, say, for example, he may be trusting you for filing of income tax return or a GST return, or when he created a will, he paid you professional fees because you helped him create the will, register the will with all the legal process. Now it becomes extremely difficult here at this point of time to ascertain whether there exists a client relationship when you accept this position as executor of the will. It is important that you get the engagement letter duly signed by the client, uh, confirming that the service that you are rendering is not out of your client relationship, but it has more to do with your family relationship, because of which you are doing this pro bono. So I would suggest everybody that you at least document this as a part of the engagement letter, preferably get it signed by the client. Obviously, the deceased will not be available who has appointed you, but at least other family members who agree that you are working pro bono for them. Similarly, it says insurance broking. Yes, uh, the institute's FAQ says that it involves managing of clients' money, and therefore, if you do this activity, you become a reporting entity. Similarly, trustees. Lot of chartered accountants, they act as trustees in various public trust or and even in some private trust. So the view of the institute here is that if it is for altruistic purpose, there is no client relationship, you have not been receiving any remuneration. It says that this trusteeship will not be considered uh, for the purpose of you becoming a reporting entity. But at the same time, if it's a private discretionary trust, yes, you would be appointed as trustee only because you are a professional. And once that client relationship is established and you continue with the private discretionary trust, uh, the chartered accountant in practice will become a reporting entity. So a question is, as a CA, if I handle financial transaction using a power of attorney, does the PMLA Act gets invoked and will it be applicable to me? It says yes, CA in practice executing certain financial transaction under a power of attorney will fall within the purview of PMLA 2002. However, it is crucial to remember that this only applies if the transactions is carried out in the course of your professional relationship. That means the client relationship has to be established. If the client relationship is not established, then you're probably not a reporting entity under the third way notification. One of the relative has given a power of attorney to manage his financial transaction duty due to his old age. Will I, as chartered accountant, be treated as a RE? So what is important is that you should have a well-defined scope. How will it help you? First, there would be clarity on professional versus personal transactions. It will help you define what is professional liability on you. It will help you identify the PMLA relevant transaction if something needs to be reported, because if it's a client relationship transaction, it would attract PMLA, and therefore you have to be vigilant in reporting of such transactions. And this will overall help you to protect yourself, to prove that whether it was a professional, the transaction was being done in your professional capacity or in your personal capacity. So does this mean that I can just ignore the PMLA for all personal transactions? So whenever it is a personal transaction, can I say the PMLA is not applicable to me since it's at inception? Yes, you may say so, that if it's a personal transaction, the PMLA will not apply. That is, the third May notification will not apply. But remember that there is another circular which is of 9th May, which is applicable to a lot of other professionals, and then you may get prosecuted under other provisions of PMLA or Code of Ethics under the uh, 9th May notification. So, what are the obligations of chartered accountants as reporting entities? So, what they are supposed to do? I mean, once you say that you are a reporting entity, so you will have to first verify the identity of your client and establish the beneficial ownership. Beneficial ownership means who ultimately owns or enjoys the fruit of this entity. So, say for example, there is an X Limited on behalf of whom you are going to do some transaction in your professional capacity. X Limited as shareholders, which is Mr. A and A Limited. So, you will have to identify that if there is a shareholder who is a non-individual, you will have to identify who owns and control A Limited, and along with the stake of Mr. A, who is the ultimate owner of this and the structure or group of entities. You will have to maintain such records, and for such period as may be prescribed, you are required to carry out the enhanced due diligence and report it to the concerned authority, which is the FIU, as per the prescribed procedures and manners. So, what is an AML workflow? So, once you are a reporting entity, how do you start implementing this as per the guidance issued by the FIU and the guidance issued by the C Institute? So, the first and foremost thing is you are a practicing chartered accountant. As a part of your client relationship, you are going to manage certain transactions of your clients, and they fall within one of the categories of those five specified transactions. So therefore, now you are a reporting entity. So once you are a reporting entity, you will have to first go and register yourself with the ICAI. Once you have registered, you will have to establish the policies and procedures. Having established the policies and procedures, you would have to appoint two officers, which are called the principal officer and the designated director. We will come to the roles of each of these entities. As a part of the broad structure, having defined these aspects, then you will onboard a client. While at the time of onboarding, you will carry out the KYC, which is the know your client or know your customer process. You will do a customer due diligence. You will do the enhanced due diligence or sanction screening. You will do the monitoring of transactions, which is suspicious transactions and counterparty screening. Reporting to FIU India through ICI if you find there are any suspicious transactions. And The important aspect is maintenance of records. You have to preserve the records for a certain period. The employees are required to be trained, and you will have to carry out a periodic review of this entire process. So let us understand the first aspect, which is the registration of the reporting entities. Institute has given exhaustive guidelines on how this registration process is to be handled. So the practicing chartered accountants engaging in the specified activities, they will have to fill up these specified forms. The forms have been given in this link. It is also available on the portal of the institute under the PMLA compliances or PMLA guidelines section. So please go and download this form, and using this form, please and the instructions given therein on this link, go and register your firm or the entity as a reporting entity with ICAI. The next is to have policies and procedures. So there are various policies which the reporting entity will have to provide for. So it will start with appointment of designated director, principal officer, and a branch level compliance officer. So if a firm of chartered accountants has, say, for example, have three branches, the designated director and principal officer, apart from them, each branch we would have to appoint a compliance officer whose role will be equivalent to what a generally a principal officer will do. Uh, then customer identification. You have to identify the customers properly using certain documents which have been prescribed. Do the risk profiling of your customer based on the categories, the countries from which they come from, their background, like if they are politically exposed, so on and so forth. Once this is done, you will decide whether to accept this client as a customer or not. So that's a customer acceptance policy. Then you will have customer transaction monitoring, because uh, it would be a bits and pieces of transactions being executed by different people in the organization, and therefore to monitor the transactions effectively, you need a comprehensive policies and procedures. Then the transactions that are being carried out on behalf of the client, you will have to match it with the red flag indicators. In the financial transactions, these red flag indicators have been provided to the members by ICAI. They are available on the SSP portal under PMLA compliance section, which you can go and read out. I would request everybody to at least go once and read out, I mean, download this, keep it for your safety. I mean, make everybody aware in your organization the kind of red flag indicators, so that they are aware of what kind of transactions they should be monitoring more diligently, what are the parameters that should be monitored, and what is the escalation metrics, what are the exceptions, and how are they to be reported. So based on red flag transactions, if there are any transactions which look suspicious, the principal officer and the designated director review those transactions, and if they are found suspicious, they need to be reported to the FIU India. But this reporting will be done through ICAI. So as member of the institute, I would report this transaction to ICAI, who in turn will report it to FIU. Uh, we will also have to have a policy on maintenance of records, because there could be certain transactions which may become suspicious after a period of time, or if they are found to be suspicious, you may need certain other supporting um, documents or records to identify what kind of transaction was this. Now, so we come to the appointment, I mean, the designated director and principal officer. The first step is appointment. So the regulated entity would appoint a designated director who is the managing partner or the proprietor, as the case may be, and would also appoint any officer as principal officer. So designated director is a person who is of the highest level in the organization's hierarchy, while a principal officer can be anybody who is senior in the organization. But in case there are professionals who are practicing in their individual name, so say for example, I am Kinjal Shah. I may either have a firm, a partnership firm, or a proprietary concern, but I may also opt not to take end company or an associate kind of a tag, which is for proprietorship concern or partnership firms, and I may opt to practice in my individual name as Kinjal M. Shah. So in that case, the the professional themselves will serve as the principal officer, and they probably may not be required to appoint designated directors. So the designated director is required to ensure the overall compliance with obligation under Chapter 4, and the principal officer is required to do the reporting of transactions under Rule 8. So while this may look very simple, but the responsibility is very onerous. The DD and the PO, which is the designated director and principal officer, they both need to be very diligent in performance of their duties. And overall, they would have to implement the internal mechanism, communicating the firm-wide policies, and they will ensure compliance with all the statutory requirements. So, what are the steps involved in onboarding as well as going forward once the client has been onboarded? So at the time of onboarding, you will have customer identification, customer due diligence, risk profiling, sanction screening, and risk assessment. And on an ongoing basis, the reporting entity, on an ongoing basis, the reporting entity shall conduct the enhanced due diligence of the customer's transaction. It will do a transaction monitoring. It will also have to do a counterparty screening, and all put together, if the transactions are found to be suspicious, it needs to be reported. We will deal with each of this process in the subsequent slides. So I am not elaborating as of now on the processes that needs to be done for each of this task, but we will deal with it as we come to that slide. So one of the requirement is of having a robust mechanism in place for complying with the KYC requirement prior to onboarding the client, and it may also need carrying out re-KYC at periodical intervals to ensure continued due diligence of the existing customer. So KYC doesn't mean only once, but if you have visited banks or you have dealt with banks, you will realize that at periodical intervals, they keep on asking you for the KYC documents. So as a reporting entities, we will also have to do the same thing, where we might have to periodically set the time frame, and based on those time frames, we'll have to do a re-KYC of the clients, which under for which we have become the reporting entities. Friends, while KYC norms, they have already been applicable for all engagements pertaining to the attest function, and this has been made mandatory from 1st January 2017. I hope everybody is aware that your attestation function includes all those activities where you generate a UD, which is a attestation function, and For all such engagements, you will have to first do a KYC of your client. While in the normal course, if you do a tax audit or you do a statutory audit, you more or less comply with the KYC norms because the kind of documents that you will see in subsequent slides are already obtained as a part of the audit documentation. But at times we need to be careful that we issue certificates for people who are not our regular clients. Like, say, for example, you are a chartered accountant and help a client file a return, or you may be doing a tax audit for Mr. X. Now, Mr. X son, Mr. P, is applying for visa to a foreign country, and the embassy of that country, before he goes for the interview, has asked him to get a net worth certificate of his net worth from a chartered accountant. So obviously, Mr. X would call you saying that I want the net worth certificate for my son, Mr. P. Please arrange to issue this certificate. Be careful that this would be treated as an attestation function, and therefore you will have to comply with all the KYC norms as applicable to engagements pertaining to attest function. So institute has given detailed guidelines on the KYC norms. For individual proprietor, it says that you have to obtain the name of the individual, the PAN or Aadhaar card. You will have to take the business description, the copy of the last audited financial statements. If they are not being audited, you obtain the financial statements. If the client is not required to file the maybe say the tax audit report or a statutory audit report, you will have to obtain corresponding equivalent proofs like his bank account statement and such other documents to prove the credentials and the financial strength. You will also have to document the type of engagement that you are being appointed for by a client. That is where it is very important for chartered accountants to obtain the engagement letter. I hope most of us are aware that Institute has come up with the applications, various ready-made prepaid engagement letters, pre-prepared engagement letters, where you fill up the basic details and your engagement letter is ready. This will also help you to comply with the standards on auditing and will also help you to comply with the PMLA guidelines. In case of corporate entity, it is the name and address of the entity, the business description. You will also have to obtain the name of the parent company in case it is a subsidiary of a company, copy of the last audited financial statements, the type of engagement, the PAN number, company's identification number, the director's name and address, and the DIN number. While most of this information or document is already available, if you are doing a statutory audit, considering that as a part of the audit documentation, you would have obtained it. If it is a non-corporate entity, it says the name and address of the entity, the copy of the PAN number, the PAN card, the business description, partner's name and address with their PAN and Aadhaar, the copy of the last audited financial statements, and the type of engagement. What is the purpose of client identification? The aim is to verify the identity of both individual and non-individual clients, the companies, trust, engaging in financial transaction, and this extends to identifying the beneficial owners. So when you are going to deal with your client, it is always advisable that you obtain necessary documents, you know your clients. This is also one of the requirement under the code of ethics and the standards on auditing. This will help you to design your due diligence process accordingly and help you to identify transactions which could probably be suspicious in nature. So who is a beneficial owner? Because we keep on talking about identifying beneficial owners. So generally our understanding is, if it is, say, let's say for an example, if it's a company, and it would generally be, if it is a small or family managed company, that Mr. A and Mrs. A are the promoters of the company along with few of their other family members, and Mr. A along with his wife or his brother or somebody close relative would be the director of the company. But friends, let us not forget that in today's scenario, where this kind of entities, when they indulge into some transactions which are illegitimate, it is very important for us to carry out a proper identification of our client, and which includes the beneficial owner. So who is a beneficial owner in this case? So the beneficial owner under section 2FA of the PMLA Act means it's an individual who ultimately owns or controls a client of a reporting entity or the person on whose behalf transaction is being conducted, and includes a person who exercises ultimate effective control over the jurisdiction person. So what is important is there have been a lot of instances where people have made their junior employees or even like say drivers or maids to be the directors of the company. And since those people are not educated, uh, they they are in control of the people who indirectly own or manage this company. While this company may be used to carry out some illegitimate activities, the real owner would not be known in such cases unless we carry out enhanced level of due diligence. What is the criteria for identifying the beneficial owner? So it says that criteria are based upon the percentage of the shareholding or profit sharing. This has again been extensively defined, and therefore it is advisable that we refer those circulars or clarification, and based on that, we frame our customer identification policy. What is customer due diligence? So, customer due diligence includes identification and verification of clients, conducting a risk assessment, then continuously monitoring the transactions of the client on whose behalf you are transacting, and applying enhanced due diligence for high risk clients. The reporting entity should obtain the names and details of individual holding senior management positions. So here what it says is that as a part of the due diligence process, not only the identity or address proof that you have obtained for the individual shareholders holding the number of shares above the specified threshold, but it says that you should also do this for the people at the senior management position, the beneficiaries or trustees or settlers and authors, and details of their clients, registered office, and principal of place of business. So ideally, we have come across instances in case of certain companies where the professionals were appointed as directors. So those professionals incorporated the company themselves. They became the directors. They never knew who were the owners. They only met certain set of people who convinced them to continue as the director of the company or help them manage the company for a specified professional fees. Uh, we have certain instances where the neighboring countries were controlling those entities, and those entities were used for money laundering, and such similar activities. That is where it is our very onerous responsibility that we do not become partners of such crimes and safeguard ourselves if we are being misused as professionals by such entities. So, what is the purpose of risk profile? So, it says that based on the risk profile of the client, the extent of due diligence frequency of transactions can be understood. So, this will help you once you have done the risk profile of your client. It will help you to understand that to what extent you will have to be diligent in the course of transacting with these companies, the frequency of monitoring of these transactions, and such similar activities. So, what are the kind of information that one can use for doing a risk profiling? So, the institute FAQ says that information such as nature of employment, business, the geographical location. So, the illustration that I gave just few moments back, had those professionals conducted the geographical location of the true owners of that company, uh, they would have become suspicious probably of the activities that this entity could conduct, and they would have been able to safeguard themselves. Similarly, any publicly available information can also be used for risk profiling of the client. By risk profiling can be done extensively, but what is at least desired for all the professionals is to conduct a minimum level of risk profiling. And what are the some factors that could be considered? It could be that if the entity with whom you are going to deal is a politically exposed person, or it is involved in cross-border transactions. So such entities should be given a higher risk compared to other clients. So let us understand what is a politically exposed person. The politically exposed person here doesn't mean any person who is associated with a political party or is into politics. So the definition says it's an individual who has been entrusted with prominent public function by a foreign country. This is very important that he has to be entrusted with this function by a foreign country, including the heads of states or governments, senior politicians, senior government, or judicial or military officers, senior executives of state-owned corporations, and important political party officials. But again, all these are people where you have to remember that they have been entrusted their duties by a foreign country. So let's say, for example, a local MP or MLA is a person whom you are going to serve, whether he would be treated as a politically exposed person. The answer is no, because he has not been entrusted with this duty by a foreign country, but he has been entrusted his duty by the government of India or for the people of this country. So RE shall conduct sanction screening during the onboarding process and when any of the notified activities as per the notifications are carried out. So what is a sanction screening? There are various entities or individuals when they are found promoting terrorist financing or I would say distribution of arms and ammunition and conducting such illegitimate activities. The United Nations would come out with a list where they would ban or inform the world or the at large that these are the people who have been barred, and therefore you are requested not to get associated with such person. So what is required as reporting entities? we should go to the link of the sanction list, which is also given on this page in the presentation provided by ICAI. There are various lists which has been shared by ICAI. We should go and check that the client that we are onboarding or we are getting associated with is not has not been named in any of this list. So then we come to risk assessment. What is risk assessment? So it says that RE should carry out risk assessment. So it says that RE should carry out risk assessment to understand the risk exposure. It should adopt a risk-based approach to facilitate priority allocation of resources for appropriate control and oversight of AML and CFT or CPF safeguards, implement appropriate policies, procedures, and controls to manage and mitigate the identified risk, document and update the risk assessment regularly, considering that all relevant factors to determine risk levels and suitable mitigation measures. So this is the responsibility of the reporting entity as a part of their risk assessment. So what is enhanced due diligence? So enhanced due diligence refers to more rigorous and robust measures undertaken by a relevant person, which here would be the reporting entity, when dealing with complex, unusually large transactions or unusual patterns of transactions with no apparent economic or lawful rationale. So there are various categories of such transactions as a part of the red flag indicators, which ICI has shared with the members on the SSP portal, which would help us to identify such patterns. But again, it is only an illustrative list and not an exhaustive list. Every member is supposed to conduct his own due diligence based on the nature of transaction that he is going to undertake. When should EDD be conducted? So it says that EDD should be conducted when the risk of money laundering, terrorist financing, or proliferation financing are higher. So any transaction where you perceive that such risks are higher in a transaction, you should be doing enhanced due diligence. What are some of the measures that you should be carrying out as a part of the EDD? So again, some indicative measures where there are more, you can have more frequent review of customer's profile. So in a normal case, say for example, you do a KYC of the client once is onboarded after every 2 years. If you find that there are some clients who needs for which an enhanced due diligence needs to be conducted, either say for example because he comes from a country which is carrying higher risk, or say for example is a politically exposed person, uh, then in such a case you may carry out the risk profile of the customer or the review of the customer's profile at a reduced periodicity. That means you can do it at an interval of say, let's say one year or 6 months. You should be there should be an application of additional measures like gathering information from publicly available sources or otherwise. You should have reasonable measures to know that the source of fund is commensurate with the assessed risk of customer and product profile, which may include conducting independent inquiries on the details collected or provided by the customer where required, consulting a credible database, public or otherwise. There are various databases which are available. Some are free, some are paid. There are also softwares which are available in the market, which at a click of a button will help you to do this activity. So EDD with respect to high risk jurisdiction, person or entity. So at the time of onboarding the client, it is required that the natural and legal person from higher risk jurisdiction, specifically with countries designated as tax havens or those on FATF gray list and blacklist, Like say for example, you we all know that Pakistan was there on the grey list of FATF for almost 1.5 year before it was removed from that grey list. So any country which do not have adequate mechanism to detect money laundering and do proper reporting, the FATF when it conducts its review, it would put it under such risk categorization, which is grey list and blacklist. Like say for example, Iran and North Korea are on the blacklist because they have not been cooperating with FATF in implementing adequate provisions to detect, prevent, and report the money laundering transactions. Similarly, if you have a politically exposed person, and in case where relevant persons as notified and the notifications are not able to undertake the required EDD, they must file a suspicious transaction. So what we need to understand is that the institute or FIU India does not consider us to be James Bond, that we will have to go and identify all the required details. But what it says is that you should try and accumulate the basic details. But where you are not able to accumulate the basic details, there is a good chance that it could be a suspicious transaction. We are not saying it's a wrong transaction or an illegitimate transaction, but we just suspect that there could be something which could be wrong with this transaction. And therefore, what is expected the list from us is that we report it as a suspicious transaction. So, what is a suspicious transaction? It has been defined under the PMLA guidelines issued by FIU India. And it says that suspicious transaction includes an attempted transaction, whether or not made in cash, which to a person acting in good faith gives rise to a reasonable ground of suspicion that it may involve proceeds of an offense specified in the schedule to the act. The value doesn't matter here, or it appears to be made in circumstances of unusual or unjustified complexity, appears to have no economic rationale or bona fide purpose, or gives rise to a reasonable ground of suspicion that it may involve financing of the activities relating to terrorism. A simple or very good example could be that when you are dealing with a client and you review the transaction, you find that your client is, say, for example, dealing in a product which is textile. But while he is dealing in textile, the purchase should also be correspondingly of the related raw material. But you find that out of his purchase, out of his total purchase, there is an invoice which pertains to more than 20% of the total purchase for a product like, say, gold. Now, that is a reasonable ground for us to arouse our suspicion that how could gold be treated as a raw material, especially when the client is into textile business. So this is a transaction which do not have any economic rationale. It lacks a bona fide purpose, and therefore this could become a good ground to, I would say, investigate or review the transactions, obtain necessary clarifications from the client, but at least wherever we are convinced, we should file a STR, which is a suspicious transaction. So special attention should be paid to all complex, unusually large transactions or unusual pattern transactions which lacks economic or lawful purpose. R is to document process of identification of red flag indicators for client transaction monitoring of the financial transactions. The red flags have been issued by ICAI. So what is a red flag indicator? It is called an RFI. The red flag indicators are signs that suggest transaction or activity which might be related to money laundering. So the indicative red flags which has been shared by institute is clients receives unusual payment from unlikely source which is inconsistent with his sales. The client appears to be living beyond his declared income or turnover. He has obtained a loan from unidentified parties. He has obtained loan on a relatively low income. His income is say 1 lakh. Somebody has given him a loan of say 100 crores. Transaction where there is lack of information or explanation, or where the explanations are unsatisfactory. Transaction with companies whose identity is difficult to establish, as they could have been registered in companies which are considered to be tax havens or have secrecy laws. There are many large cash transactions when not expected, and the apparent use of personal account for business purpose. The client's name matches with the UN list or the UAPA list or other criminal or terrorist financing list. Wire net transfers or internet to move funds to and from high risk countries and geographical locations. So in all such cases, the RE is to conduct counterparty screening when acting on behalf of their client. So what it says is, if I have been appointed by X Limited to conduct the transaction on their behalf, and the, the promoter or the director of X Limited calls me and says that we are going to purchase some product from Y Limited, please ensure the payments are being done. Now, the responsibility that has been cast on me as professional chartered accountant and the reporting entity is, then when I'm making a payment to Y Limited, I should do a screening process. So that means there are various lists which we have seen in the previous slides, which have been provided by ICAI. I should go to those lists and I should identify whether the parties to whom I am making a payment on behalf of the entity which has appointed me is not appearing in any of the such lists. It should also ascertain any emergent risk stemming from such suspicious transactions, or we have any history or adverse media reports, or there are published information about the regulatory or criminal penalties related to the client's counterparty clients. So what is the flow of reporting? The reporting entity would report it to ICI and ICI in turn to FIU. So these are the certain kinds of transactions that needs to be reported by the reporting entity, which talks about cash transaction reports, the suspicious transaction report, the wire transfer report, the not-for-profit organization report. And what is the penalty in case there are default by the reporting entity? It says that the penalty can range from 10,000 to 1 lakh. But again, this penalty is for each default, and there would be no clubbing of such defaults. So say, for example, there were a series of cash transactions which should have aroused my suspicion, and therefore I should have filed a cash transaction report as well as a suspicious transaction report. While cash transaction reports are easier to detect because it has a monetary threshold, the moment somebody crosses that threshold, the same is immediately flagged by the system. Suspicious transaction would require quite a bit more time, more efforts to identify and detect. So if I have reported the cash transaction reports, but I failed to identify the transaction as suspicious, where it was found that I was not diligent in the performance of my duty, then the FIU India can penalize me not only for uh, saying that I cannot take a rescue, saying that I have filed CTR but missed filing STRs, so STR would still be penalized. Similarly, if I have missed both the CTRs as well as the STR, it would not be clubbed and treated as one one-off case, but both of them would be separately penalized. Can civil or criminal proceedings be initiated against the reporting entities, the designated directors, or the principal officers? So the answer is no. The PMLA, the default only contemplates that there could be penalty by FIU India but there will be no civil or criminal proceedings against the reporting entities, directors, employees for failure to furnish the information. The reporting entity and the directors, officers are also prohibited from disclosing or tipping off that an STR or any information is furnished to FIU India to the clients. So they should be careful where they need to report these transactions. The client should not be informed. The client should not be threatened saying that if you don't provide this information, you will have to report this. It says that it is not your responsibility to inform the client nor to threaten him to extract the documents. The moment you feel that the client is not cooperating, says the only responsibility of the RE is to simply file an STR. So what are the records to be maintained for the reporting entities? Uh, ICI has given extensive list, which is as per Rule 3 of PML, which specifies the transactions for which the records have to be maintained. It says that the records of documents evidencing identity of its clients and beneficial owners, as well as account files and business correspondence relating to its clients. So it is very important. It is not only the transaction that has to be maintained, but all the supporting, including the business correspondence. For how many years it is to be preserved? It says that it has to be preserved for 5 years. In case after the relationship is ended, or if the engagement has been closed, 5 years from the date of closure of the engagement. What information is required to be recorded or how is it to be maintained? You need to maintain details relating to nature of transaction, the amount of currency of transaction, date of transaction, and parties to the transaction. And it is not only for this specified transaction that you will be maintaining these records, but you will have to maintain records for all transaction where you are a reporting entity. So what are the procedures for hiring of new employees? It says that you should have an adequate screening procedure. So whenever you recruit new people, do adequate procedures with respect to obtaining the identity proof, the address proof, the background checks, the criminal records check. That is all that you are supposed to do as a reporting entity. Additionally, the employees should be periodically trained. The training related to the procedures for your KYC, CDD, sanction screening, record keeping, transaction monitoring, and the instruction manual to be included as a part of the training material. REs should conduct periodic review of policies, procedures, and controls, and the periodicity has not been defined in the guidelines. So the REs are supposed to frame their own guidelines. We will skip the role of ICAI here. What is more important is to understand our role as reporting entities. While we have completed this session, I would also touch upon the important aspect of the 9th May notification, where it says that the financial transaction when carried out in the course of business on behalf of or for another person acting as a formation agent of company and limited liability partnership or acting as director, secretary of a company or a partner of a firm or similar position in relation to other companies and limited liability partnerships, and providing a registered office, business address, or accommodation, correspondence, or administrative address for a company or a LLP or a trust, or you are acting as a trustee of an express trust or performing equivalent function, or you are acting as a nominee shareholder for another person. So if any person who is carrying out these activities, he would be also treated as a reporting entity, while the previous circular had 5 set of criteria in terms of the transactions that are carried out, apart from being a practicing chartered accountant. While if we look at the 9th May notification, it does not limit itself to practicing chartered accountants or cost accountants or company secretaries, but it applies to any person. However, it says that if there are any activities which are carried out as a part of the lease agreement, that means if you have leased your office space or an activity that is carried out by an employee on behalf of his employer, or an activity that is carried out by an advocate, chartered accountant, company secretary, or cost accountant in practice, as a part of the formation service of the company, then this is not governed under this clause. And any activity of a person which falls within the meaning of an intermediary. So if somebody is already an intermediary, then he will not be covered by ninth May notification, because the act itself covers all the intermediaries. So what is the obligation under the PMLA? So as per FIU India circular dated 7th July, 17th July, these entities shall carry out specified activities referred to as trust and company service provider, and they shall become the reporting entities. If they become the reporting entities, they will have to register with FIU India directly. The reporting is to be done, or the registration is to be done using the FinNet Gateway 2.0. While in case of the previous notification, which is a third May notification, this was to be done through the nodal agency, which is the ICAI for chartered accountants. Friends, I have given certain references on which I have relied upon, which are the Gazette notifications, the Act, rules, the FAQs of ICAI, the guidelines that has been issued by the FIU India, the red flag indicators, and the 9th May notification of FIU India. I have also shared the links to the forms of ICAI for RE registration. Please follow this link and get yourself registered as a reporting entity. If you qualify as a reporting entity, the link to the KYC norms issued by the ICAI, please study this carefully, because this is also applicable to all attest function, which are applicable, and this is applicable from 2017. And I have also given the link to the sanction list provided by the ICAI in this file, where you are supposed to check that the clients that you are onboarding, they are not associated with this debarred entities or the entities appearing in the sanction list. So friends, I end this session, and thank you, the Institute of the Chartered Accountants of India and the Committee on Commercial Laws, for giving me this opportunity to share my views, and I would be happy to take any further questions on this.
Thank you so much, sir, for your knowledge dissemination on the topic. So we have some questions, and I will be reading those questions for you. So we have question from Dheeraj Agarwal. If we are incorporating any company or LLP on behalf of the clients, whether we are covered under RE? Second,
No, the institute has clearly stated the guidelines. Let me take you through that. So it says that incorporation of the companies, LLPs, and trust, not for buying and selling purpose. So if you are not doing it for buying and selling purpose, then you are not an RE. But where you incorporate that company, you own those companies, you get engaged into buying and selling either for yourself or for your clients, then you become a reporting entity. That has been categorically, these are given in the FAQs, both these examples where you are incorporating the companies for buying and selling purpose, and you are doing this where the purpose is not buying and selling. So as a part of your professional obligation, you help the client incorporate a company. You do some attestation function where you sign regarding the existence of the head office of the company, the directors, etc. You are not governed by this notification, or rather, you are not a reporting entity.
thank you so much, sir. So next question from Vriddhi Agarwal. What if a chartered accountant failed to report red flag transactions?
Uh, so what happens is you are a reporting entity. Any reporting entity, when it fails to report the transaction, there is an exhaustive and elaborative guidelines which has been laid down by FIU. They will generally call you to understand why there was a lapse. And here it would be the responsibility of the ICI to investigate and look into this matter, educate the members. If they feel that there are certain clarifications which are required, which were rather required, they would do all the necessary things. But the bottom line is the maximum what can happen is there could be a penalty if after all the opportunity that has been given to you, not only to put across your case, but to even to improve upon. But if that is not done, ultimately there could be penalty which could range from 10,000 rupees to 1 lakh rupees.
Thank you, sir. One another question from Kritika. What is the implication of being covered under the 3rd May 2023 notification? Does it entail criminal charges and prosecution for chartered accountants?
I have specifically covered, using the FAQs that has been given by ICAI. It specifically says that there cannot be any civil or criminal liability arising against the chartered accountant for its failure of its duty as envisaged being a reporting entity. So there can be only monetary penalty ranging from 10,000 to 1 lakh, but no civil or criminal liability attached.
Okay. So, sir,
So
one.
rather, if you look at this notification, no, Inderjit, it's something which is really beneficial for chartered accountants. Rather, when it came, there was a lot of hue and cry saying that the chartered accountants are being targeted by the present government. But somewhere the background of this circular or notification was rather to comply with the FATF recommendation number 24 and 25, because FATF review was due in December 23. So that was more to comply with those regulations. But let me tell you an interesting aspect of this notification. Just imagine had there not been this circular, and as a practicing professional, I am going to manage some of the clients' activities or funds, and I find that they are suspicious. I have no opportunity to go and tell anybody that these are suspicious because I'm covered by my code of conduct, which does not allow me to disclose clients' confidential details. So I have only two options. Either I refuse to take up this assignment, and if I continue with the assignment, I, I take up the risk of being prosecuted as an accused of the money laundering crime. But now with this notification, the biggest or rather a good advantage to a professional would be that he would be free to take up the assignments. I'm not saying that he should indulge into the crime of money laundering, but I'm saying that he is rendering a professional service. He comes across instances where the transactions appear to be suspicious. He has the opportunity to go and report it. Once he reports it, he per se would not be treated as a part of the money laundering crime. God forbidden, he forgets to report it. The penalty is still ranging from 10,000 to 1 lakh compared to an accused under the money laundering. If prosecuted, there is an imprisonment ranging from 3 years to 7 years. So there is a big difference when you are a reporting entity. And I think this circular is really, really beneficial for chartered accountants, which will give them the privilege of reporting a transaction which appeared to be suspicious. They are not supposed to tell the clients. It will not be treated as breach of client confidentiality, and it will still safeguard their professional interest, having performed their duties as a reporting entity.
Okay, sir. So thank you so much, sir, for answering all the questions. So it's time to conclude the webinar. So on behalf of the organizing committee, I extend our heartfelt gratitude to CA Kinjal Shah for this enlightening session. So your insights have truly enriched our understanding on the topic. And we also thank our participants for their active participation. So, looking forward to more fruitful collaborations in the future. Thank you, everyone. Have a good evening.
Thank you. Thank you for giving me this opportunity.